Bull and bear markets explained. Bull markets refer to a surge in the value of the stock market. It's basically when prices of stocks are going up because a lot of investors are buying those stocks. Bear markets are when the opposite happens, the stock market falls, and people sell their shares or stop buying them. So, in a nutshell, when prices are rising it's called a bull market, and when they're falling it's called a bear market. Pretty easy, right? Well, not really. You see, while the terms are pretty easy to understand, the history behind them, the reasons why they happen, and how you can navigate them as an investor are very complex. However, we'll be going over all of that today. Hey guys, welcome to my channel. In today's video, we'll be going over the history of bull and bear markets, a great example of how they happen, and everything you need to know about them as an investor. Without further ado, let's get started. The terms bull market and bear market have been around since the 18th century. The first recorded use of the term bull market was in 1792, when British journalist Samuel Johnson used it in his book A Journey to the Western Isles of Scotland. The term bear market was first used in 1834. They are called the bull and the bear markets based on how the animals attack. Bulls will charge at their target and then knock it down with their horns. This analogy is often used to describe the way that bullish investors will push prices up and then sell at a higher price, crashing the stock market in the process. Bears, on the other hand, will stand on their hind legs and then swipe at their target with their claws. This analogy is often used to describe the way that bearish investors will short stocks when prices are high, and then buy back when prices fall, profiting from the decline in prices. There are a number of reasons why bull and bear markets happen. Some believe that they are caused by human emotions, such as greed and fear. Others believe that they are caused by economic indicators, such as GDP growth or inflation rates. And still, others believe that they are caused by political and social factors, such as war or changes in government policy. However, there is no one cause that is agreed upon by all economists. In reality, it's probably a combination of a few of these. The best example of a bullish and bearish stock market run happened during the turn of the millennium. The rapid growth of the internet at the time created a buzz among investors, who started pouring money into any and every company that had a .com domain name. All of these companies were able to go public and sell stocks without any business plan, product, track record of profits, or even a roadmap of success. Once public, the stock prices for all these .com companies skyrocketed, creating what is known as one of the longest and largest bull markets in history. Beginning in March 1993 and ending in March 2000, the S&P 500 returned an average of 17.9% per year. For comparison, the long-term average of the S&P 500 is around 10.43%. However, as we all know, nothing lasts forever. So, in March 2000, the dot-com bubble burst, resulting in one of the most disastrous bearish markets we've ever seen. The dot-com bubble was caused by a number of factors, including excessive speculation, fraudulent activities, and a lack of regulation. Investors were buying stocks without any understanding of their underlying businesses, and many of these companies were selling shares without any real profits. Fraudulent activities were also rampant during the bubble, as investors were duped into investing in fake companies. And finally, there was a lack of regulation, which allowed many of these fraudulent activities to take place. The bubble burst when the dot-com companies began to go bankrupt and investors started to sell their shares. This led to a mass sell-off, which caused the stock prices to plummet. The market lost $5 trillion in value over the next 2 years, and many dot-com companies failed completely. So, what can you do as an investor if you find yourself in a bear market? Well, there are a few things. First, you can sell your stocks and wait for the market to rebound. Second, you can buy inverse ETFs, which will go up when the stock market goes down. Third, you can hold on to your stocks and hope that the market rebounds. And fourth, you can buy put options, which give you the right, but not the obligation to sell a stock at a set price. Each of these options has its own risks and benefits, so it's important to understand them before making any decisions. However, no matter what you decide to do, it's important to stay calm and make decisions based on sound financial principles and not on speculation. On the other hand, what if you find yourself in a bull market? Well, you should still be careful. Bull markets are often seen as a time when investors can make a lot of money very quickly. And while this is true, it's important to remember that bull markets can also lead to excessive speculation and market crashes, just like with the dot-com bubble. Right now, we're seeing a similar bubble within the crypto and NFT space. In times like this, it's important to do your research on the company or asset before making any investments. Make sure that the asset has utility, and it is not just mere speculation. With that, you'll be well on your way to being a successful investor, both in the bearish and the bullish markets. For more videos on investing, please subscribe to our channel and turn on the bell notification so you never miss an upload. Thank you very much for watching.